In this video, we're going to go over 5 stocks that some of Wall Street's best performing analysts like right now amid the stimulus stalemate. These are companies that have huge price targets set and are all considered a buy right now with a lot of future growth expectation. These are companies who are expected to have a very strong 2021 and may see a 10, 20, 30% potential upside over the next 12-month span. For each of these companies, we're going to go over their current price, the current performance, why these Wall Street analysts like the company and their set price target, and we're also going to go over some key financial statistics of each of these companies just to get a quick overview of how they've been performing and what we expect down the road. If you're new to the channel, everyone, I am the Gen Z investor, and every single day we talk about the stock market, we go over different stocks you can buy and sell, and discuss any major market news and headlines. And in this video, we're going to go over 5 different companies from various sectors of the market. We have some very small cap companies as well as some larger names in this list, and these are companies that Wall Street believes are going to continue to surge, have high price targets, and may have a lot of upside potential into 2021. So please hit the like button and subscribe to the channel for daily videos about the stock market, and we're going to jump right in to the first stock in today's video, which is Marvell Technology Group. Ticker MRVL currently trades below $43 per share, and this company has grown 73% this year. And although they've seen a massive run-up, analysts are still bullish on the semiconductor brand and expect some long-term future growth. Over the past year, we've seen that 73% increase, giving the company a market cap at $28.8 billion. They currently trade at a forward PE of 46, and analysts have a price target for this company set at $50 per share. They remain bullish on the semiconductor brand and indicate that the shares can grow another 17% at least over the short term. And on Marvell's latest quarterly report, they shared networking revenue of $445 million, which represented a 35% year-over-year growth from last year's same quarter. And moving forward, we're expecting storage revenue to gain 13 to 15% quarter over quarter in Q4 of this year. So they still have some strong partnerships with some of the leaders in 5G design, and this is a company that analysts still are very bullish on, although they have seen a run-up. We expect a $50 price point moving forward, and now we're going to take a look at some key statistics for Marvell. They have extremely high profit margins coming in at over 51%, which is absolutely incredible. Some nice return on equity coming in at 19%. Year-over-year revenue growth has grown 13 for the past quarter. And if we take a look at their balance sheet, a current ratio at 1.42. That just shows that over the short term, we're not too worried about any debt hurting the business. Over the next 12 months, they have a lot of current assets on the balance sheet to deal with all their short-term liabilities and will continue and remain operational. If we take a look at some future growth expectations, analysts are still very bullish on this company. Next year, we're expecting close to 49% growth, and over the next 5 years, we're expecting 37% per year growth over that next 5-year span. The company is rated a buy right now, and from Yahoo Finance, they have a price target similar to the other Wall Street analysts at around $50 per share, and their exact sits at $49.75. So still a lot of potential upside growth from this current share price. It is rated a buy with a lot of strong future growth expectations. And if we take a look, Marvell does pay out a very tiny dividend, yielding 0.56%. They only pay out around 26% of their net income as a dividend, and they actually do not grow the dividend. They've been paying the same payout for many years, and I don't expect them to grow it anytime soon. So this is not a key potential investing factor of the business, this dividend, but it is a nice little bonus coming in at 0.56%. So the semiconductor company, Marvell Technology Group, was the first that Wall Street analysts like right now amid the stimulus stalemate. And now we're going to move on to stock number 2, which is EVO Payments. Ticker EVOP, currently trading above $25 per share, is actually down just over 1% over the past 12 months. The company has a market cap of $2.36 billion, so you can see this is a very small cap company. If we take a look at the analyst report, Mark Palmer from BTIG says this company is still a top pick entering into 2021. He reiterated his buy rating on the stock with a $30 price target, which represents at least a 17% surge over the next few months. He believes that this is still a recovery play, and 20% of EVOP's business comes from the restaurant and tourism hospitality sector of the market, which he still believes has some huge upside potential once we see some future reopenings. And if you're unaware of what EVOP does, this is a payment solution company. They're operated within North America and Europe. And if we take a look right here, they do approximately 1 billion transactions in the Americas, but they offer 2.5 billion in Europe. So you can see they're highly diversified across the world, with a majority of their transactions coming from European countries. So overall, this company operates within the payment solutions. They have over 550,000 merchants across the globe, and another interesting company, especially with trading at such a small market cap. If we take a look at some future growth expectations, next year the company is expected to grow by 30%. So a huge year coming up over the next calendar 2021. And if we take a look, total revenue for this business was on an upward trend year over year, with a slight pullback as of late over the past 12 months. And taking a look at their bottom line, their net losses are very tiny. So the company in the past 12 months has brought in 450 million of total revenue, with only a $6 million net loss. And you can see here, over the past few years, they have been reducing the net loss they post each and every time. So I'm not too concerned about them posting a $6 million or a $10 million net loss over the past 2 calendar years. And moving forward, if we take a look at their balance sheet, they can sustain those small losses. They have total current assets of $714 million compared to total current liabilities of $568 million. So they have a current ratio nicely above 1. So another company where, although they're smaller, we're not worried about their short-term financial health, and they can manage those small net losses over the next few years down the road as well. And if we take a look at this company, a 30% expected growth rate, a price target set at $30 from BTIG Analyst, this is going to be another interesting play to see how they perform down the road. Moving on to stock number 3, we have the Campbell Soup Company. Almost everyone knows this brand. They have a lot of brand loyalty and brand recognition. They are in almost every grocery store across North America, and they currently trade for $47 per share. The company is down only 1% this year, and this is a well-established brand that's been around for decades. If we take a look, they have a market cap just over $14 billion, trade at a forward PE of 15.6, and have a nice dividend at 3.13%. So although this is considered a boring company, analysts still believe the share price can surge. So RBC Capital has a rate of approval on Campbell Soup. They put a buy rating and a $59 price target for this company, which represents around a 25% upside from where they sit today. And from their latest earnings report, they show that net sales gained 7%, with organic net sales up 8%. And the company additionally stated that their demand for products has been growing, and they adjusted their earnings per share and expect an increase of 31% to $1.02. So this is a slow and boring company. Campbell Soup Company. We all know what they are, and we don't expect any high double-digit growth rates from them. But you can see organic net sales up 8% is huge. Earnings per share increase of 31% to over $1 is huge as well. And moving over into Q2 2021, the company guided sales growth between 5 and 7% on a year-over-year basis. And that's still very solid report, and that number may lead to another surge in Campbell's share price. If we take a look at some of their key financial stats, they have a profit margin of 20%, and they have nice return on equity at over 36%. Overall, quarterly revenue has grown 7% year over year, like we just saw. But one thing I want to point out is that overall, quarterly earnings growth grew 86% year over year, which is absolutely incredible. And if we take a look, they also pay out a dividend. This company yields 3.13%. They only pay out 49% of their earnings as a dividend, so a lot of room to maintain that dividend payment plus grow the business. And they only grow their dividend at a very tiny rate, and their 5-year dividend growth rate average is 2.33%. So this is a very interesting company. We all know Campbell Soup, and a lot of us have probably seen their packages and their products on the store shelves. This isn't a company we really associate with a lot of upside momentum, but Wall Street analysts are still bullish on the company, expect a possible upside of 25% over the short term, and this is a brand to keep your eye on over the next few weeks. And if you want a more stable company in your portfolio that pays a nice 3.13% dividend, Campbell Soup may be a player that you want to check out. Now moving on to stock number 4, we have Zimmer Biomet Holdings, ticker ZBH, currently trading for $141 per share. The company is down over 3.6% over the past 12 months and has seen a nice recovery from their March lows. They currently trade for around $29 billion market cap and have a nice dividend at 0.68% and trade at a forward PE just below 25. This company does not get a lot of news attention, although they are a mid-cap company with around a $30 billion market cap. If we take a look, Wall Streets are still bullish on this brand. You can see they maintained and reiterated their buy rating, along with a $168 price target, representing a 13% upside from where we sit today. So if we take a look at this company, they operate within the healthcare sector, and they manufacture and sell different healthcare equipment all across the world. They manufacture and design musculoskeletal healthcare products and solutions in the Americas, Europe, Middle East, Africa, and Asia Pacific. So companies with diversified revenue streams all across the globe have proven to be long-term and very sustainable holdings. Companies who are not focused and solely rely on one geographical region really tend to outperform over the long term. So if this company can continue to dominate and grow their international holdings and revenue streams, maybe a nice pickup, and we're expecting some huge growth over the next year. They were founded in 1927, so you can see that this company's been around for decades and decades and have proven to remain and grow over a longer term span. And if we take a look, next year the company is expected to grow by 42% growth. So an incredibly high growth expectation for the next calendar year for ZBH. And if we take a look, the company is rated as a 1.9, which indicates a buy and a strong buy rating, a current price at around $141, and the Yahoo Finance price target shows an average expectation to be around $158 over the next year. And this company does pay out a tiny dividend as well, yielding 0.68%. They only pay out less than 17% of their earnings as a dividend. So of course this company is not known for the dividend, and we're expecting that capital appreciation, but it is nice to tag along a nice 0.68% yield, but the dividend does not really grow, so it's going to be maintained, and each and every year you might actually be losing a little bit of money to inflation with regard to the dividend payment. So overall, this was the fourth company they took a look at. ZBH, currently trading in that $143 price, an interesting brand within the healthcare sector that is poised to grow over the next year, coming from Wall Street Analysts. And now finally on to stock number 5, and the final company we're going to look at today, we have ticker HUBG, Hub Group Incorporated. They currently trade for around $58 per share, and this company's up more than 17% this year. Another small cap company with a market cap just shy of $2 billion that analysts still believe can surge even higher. If we take a look, they just made a big acquisition of Nonstop Delivery. This is a last mile delivery service, and the company Hub Group just purchased them for $94.5 million. And they believe this will help expand their supply chain solution and help really develop the overall aspect and overall vertical integration of Hub Group's total services. And if we take a look, the analysts are expecting high 2021 earnings per share forecast, and additionally, they actually received a bump up in price target to $65 per share, representing more than 12% upside from where we sit today. If you are unaware about this company, because they are actually tiny, they operate within the industrial sector and are air freight and logistics. So this is an asset-light freight transportation company. They offer different logistics for different transportation methods, such as trucking, truck brokerages, and other logistics services within North America. So they operate and own around 38,000 53-foot containers for use on the Union Pacific and Norfolk Southern railroads. So railroad companies have been growing tremendously as of late, and there are really only 3 railroads that really dominate the entire North American market, which are Union Pacific, Canadian Pacific, and Canadian National Railway. Those 3 really dominate the entire industry. And if you take a look, the fact that they have 38,000 containers with one of the largest railroads in the world, they just shows that they have a strong infrastructure and will continue to grow. And moving forward, we're expecting 42% growth from this company next year, which is absolutely incredible. And if we take a look down the road, this company has been growing nicely. Total revenue year over year has been growing. You can see 2.7 billion, 3.1, 3.6, 3.6, with a slight pullback as of late, and overall this company is profitable. Making positive net income over the past 5 years is great to see. So Hub Group is the 5th company Wall Street sees some potential upside in moving forward. This was an interesting video. A couple companies I wasn't too aware of before reading this article and going over their expectations for the future, but overall, even amid all the crazy news regarding stimulus, these are the top 5 companies that some of Wall Street's best performing analysts really like right now, and they all believe have some upside to grow into 2021. So thank you for watching, everyone. I am the Gen Z Investor, and see you in tomorrow's video.